Hello and welcome to CAP STRAT this week. Mike, Fed's job just keeps getting more interesting, huh?
Mm-hmm.
We'll start with inflation, seeing a little bit of progress on the inflation side, but seeing some potential signs of weakness on the other side of that dual mandate. So we'll get into that in just a second here. But disinflation, it's back. Let's start by talking about what's actually happened and then these dotted lines here that we are quote unquote projecting out.
The core CPI print for April, 0.3% month over month. More importantly, on a year over year basis, 3.6%, which is the lowest year over year figure since April 2021, before all this inflation mess had reared its ugly head. So that's very notable. But we had talked about over and over throughout the year that the mix of inflation, where it's coming from, is just as important as the overall level. Right. Because we need to feel confident in the mix in order to feel confident that the disinflationary progress is likely to continue. So this is a chart we've shown quite a few times. If you take the core CPI basket and you break it into these three subgroups, goods in blue, that's not a problem. Those have actually been deflating. Goods prices have been falling since late last year. Things have been getting cheaper, actually. Shelter, that's going to be a long process, because of the lags incorporated with how owner's equivalent rent is measured within core CPI. If you were to look at measures of new rents, if you're out renting apartments or whatever the case may be, new rent prices have disinflated quite a bit. That purple line is just going to catch down to those market rates over time. So that's less of a concern. The concern is the green line, services X shelter. Got to a boiling point in the March CPI. That March CPI print, which of course the market received in early April, that's what firmly pushed the market into that no landing type market regime where bond yields higher, stock prices lower, Fed rate cuts fading, the idea of cutting rates coming off the table. So what was great about April is a lot of the components of services inflation that we had flagged that were largely responsible for this big uptick in services inflation we've been experiencing year to date, they sort of came off the boil. So that was good to see. And so you see that green line start to tick down. Also, we had 4 consecutive CPI prints hotter than expected. This one was in line.
Right in line. Yep.
Which was great. So all those things are good, and they're still not good enough yet. So we need to do some forecasting. If you take the April CPI print and you say on a month over month basis, up 0.3, rounds to up 0.3, and we get that same exact month over month figure for the next 2 months, that's what the dashed line would be. You can see how quickly the services X shelter would fall. It would fall down to something that is very reasonable if you're the Fed. It would create an inflation mix that's not overly worrisome, especially when you were thinking, hey, this green line going up might be because the labor market has been too strong for too long, and now higher wages are filtering into services prices. So this is a great sign for markets. That was a great report. Yep. Obviously, it would have been nice if it was cooler than expected, but the mix was very favorable. And if this continues for the next 2 months, the Fed is going to be at that July Fed meeting with a yellow or a green light to start a cutting cycle from the inflation side.
From an inflation perspective, right?
Right.
Yeah. And this is the side of the dual mandate that we've been really focusing on year to date, right? With the thought process being, will inflation slow down enough to allow the Fed to cut? Mm-hmm. But now we're starting to see some potential signs of weakness on the other side of that mandate, the full employment side. So, looking at ISM, PMI, manufacturing, and services surveys from an employment-specific perspective, Mike, what's going on here? I mean, we're looking at 3-month moving averages below 50 for recent history here.
That's the worrisome component here. And if we take a step back, what's really happened here in May is any economic surprise index you look at has fallen like a stone. And so that's a bad thing. That those surprise index, what they do is they take in all the economic data in the US and they aggregate, are they coming in better than expected or worse than expected? So those economic surprise indices falling, now many of them are at the lowest levels in 5 years. So the economic data in May has been disappointing. And when you look at, well, what type of data? Because that matters, right? What's been so disappointing? There are only two real hard data points that have disappointed. One was the April jobs report, which it came in below expectations, but it's not like, hiring stopped, right? 175,000 jobs added. That's not too bad. Retail sales in April wasn't great. And then all the other economic data points that really have been disappointing are more survey-based measures, soft data. And the reason why we draw that distinction and why we think that's so important is because the soft data in this cycle has been the stuff that's been saying imminent recession and has been wrong, right? Because the hard data, it doesn't matter how bad consumers feel about the economy, they're still spending money, right? Soft data bad, hard data still good. And so you look through those survey data points, the two survey data points that we think are a little more useful, two of them that are a little more useful, are the ISM PMIs, services and manufacturing. PMI, Purchasing Managers Index, you survey purchasing managers and you say on a month-over-month basis, are things expanding or contracting? Is momentum picking up or slowing down? And they've had a pretty good read on it. So we're now at a point where if you were to just look at the full PMI for services and manufacturing, they're both below 50 now, meaning contraction. That's new, right? Manufacturing has been contracting for a while now. We've known that. If you go back, that's why goods prices are going down. Good news, bad news, right? But services PMIs have been very resilient. The services side of the economy has been what's been keeping the economy afloat really since, mid last year. And so now to have services PMIs drop below 50, that's notable. And then you get to the point of the chart. Within those PMI reports, specifically asking about employment. So are you hiring more? Are you canceling hiring plans? 3-month moving average of those on the services and the manufacturing side now below 50. So that is key. It's not hard data. It's a leading indicator. The ideal would be if the services and employment side of the economy are saying, hey, we're canceling hiring plans, we're fully staffed, then that would mean the economy would slow from there and you would start to see it show up in the labor market, which has the labor market thus far has defied all expectations, right? So notable for a few reasons. They're both below 50. That's not good. If you were to average these two lines, this is the lowest level outside of a recession ever. So we're just waiting for the hard data follow through. Do these survey-based leading indicator sort of soft measures actually translate into getting a string of really weak non-farm payrolls reports or seeing initial jobless claims start to rise? That's what we would get worried about. But this whole idea, it speaks to, once we move into the bumpy landing, it's not immaculate, right? This is what we're talking about. We get that good inflation print, but it's not immaculate. There are costs to it. It's a good news, bad news type situation. So that's sort of where we're headed to.
And one of the aspects we talked about is of the bumpy landing is, sometimes it's in the immaculate, sometimes it's in the no landing. And I mean, you just saw that, right? With that April CPI report, it felt like no landing. And then maybe we've kind of crept back into immaculate landing from a market performance standpoint. But you kind of average that all up, maybe it ends up being bumpy. So
exactly.
That'll be interesting to see. And to the point of this being soft data and where it could come into hard data, right? We have these two components of our recession indicator, initial and continuing jobless claims. You can see a slight uptick, but still well below those, recession model levels.
Right. So there's a level of, because initial jobless claims, if you were to just look at the number and you look at 12-week average, 4-week moving average, whatever, that's not what we're showing here. But if you just look at the levels, they are rising. And there are seasonal adjustment factors, but even if you normalize the seasonal adjustment factors, take out COVID, they're still rising. So they're rising to a level that we think gives us a lot of confidence that we're not going through a wage price spiral, right? This services inflation, it is going to come down. in a way, this is giving us more confidence that the
On the
disinflationary
inflation side.
trend is reemerging. It's happening. The Fed's going to be able to cut, right? But if it goes too far,
Yeah.
that's where we start to worry about a recession.
Yeah.
We're not at those levels. We're not at those levels. We're at the sort of Goldilocks point. You need some turnover in the labor market. You need some increase in the unemployment rate to make sure that we're not so worried about inflation, but you don't want it to go too far.
Yeah.
That's when we move from just right to too cold, and then we go into a recession. We're not there yet. That's the point of our recession indicator.
Yeah, and that's why the immaculate landing has its name, right? And why it's such a relatively low probability is that's a thin
In
needle to thread.
reality, it doesn't exist.
Yeah.
It's a figment of the market's imagination, unfortunately.
So let's explore that imagination a little bit further. Timing the first rate cut. So here's taking all the things we've talked about here and trying to handicap this a little bit.
Mm-hmm.
So we've got a Fed meeting in late June, late July, and we've got CPI, PCE, and jobs reports at various dates between now and then, right? So here in the green, we're looking at that trend inflation that you were describing earlier. If we take April and we look at that over the next 3 months, you're sitting here in July at 2.5% core PCE 3-month moving rate, right? That, to your point, is yellow light, maybe green light from an inflation perspective to hike in July.
To cut.
To cut, yes. We're going to keep doing that until we get cuts. So it potentially cut in July. But those wild cards we were talking about, you got 2 jobs reports between now and then. That could be the reports that actually accelerate a cut timing as opposed to inflation saying cutting is okay, right?
Mm-hmm.
So
exactly,
you could start to see these probabilities move pretty good.
Yeah, we still think July 31st will be the first cut in the cycle. The market only thinks there's a 20% chance, but everything you just laid out, the fact that there's potential here for the labor market to slow, and we think the disinflationary process, we have more confidence in it now because we're getting some softening in the economic and the labor market data, that this probability is going to start rising. And then going back to the fact they are cut biased. We've said this multiple times, and I know it seems far-fetched because it hasn't happened yet, but if you get some weakness in the labor market, the entire narrative here is going to shift, in our view, very quickly, maybe overnight.
Yeah.
All of a sudden, you get a couple bad jobs reports, and it's, Fed, what are you doing?
Yep.
Why are you not cutting? You're doing it again. You left rates too high for too long. So it can change very, very quickly. There's another dynamic going on here, right? So if you go back a year ago, economic data is deteriorating. It's looking like potential recession. And we were definitely more advocates of being more defensive in terms of portfolio positioning. Well, why was that? That was because the Fed was hamstrung at that point. The Fed was not in a position where inflation would allow them to respond to weakness in the labor market in a way that would save the market, the equity market.
Yep.
Inflation was too high. They would be hamstrung. They wouldn't know what to do. It's totally different this time around. We could see weakness in the labor market. We could see recession fears reemerge, but inflation will be at a point where the Fed can respond to that quickly with minimal hem-hawing or hesitation.
Yeah.
And they have plenty of room to respond.
Right.
You're starting at a Fed funds rate of 5.25. The neutral rate is probably somewhere around 3. Very quickly, they could deliver, and once again, we know this seems far-fetched, but if they have to respond to deterioration in the labor market, and they can respond by cutting rates 2% before even getting to the neutral rate, that is very reassuring to markets.
Yep.
Very reassuring. And a total opposite of the situation we were in last year. You'd say similar economic developments and events, but the Fed's reaction function this time, they're much better prepared to soothe markets than they were a year ago.
Yeah. Yeah, exactly. I mean, healthily above neutral. So, I mean, you don't even need the inflation picture to clean up per se before you start cutting.
Right.
So let's take a look at how markets are responding to all of this information. You'll notice the first column here, month to date for the month of May. You can kind of get a nice picture of that bounce back between the no landing and the immaculate landing, where you got some nice green numbers in May, recovering from some of those April losses where you can see some returns still negative quarter to date.
Mhm.
But what's the overarching message here from a fixed income return
Yeah,
standpoint?
we've seen the 10-year Treasury yield move down from 4.7 down to close to 4.3 in very, very short order.
Yeah.
Because if you're invested in longer term bonds, you want to see weakness in the economy to feel confident that inflation is coming down and say, hey, if it gets any worse, the Fed's going to cut, right? And so all those things starting to happen. Still hasn't been the place to be here to date.
Yep.
Absolutely not. But, you can feel that sort of bumpy landing market regime where it makes sense for investors to own some duration.
Yeah. Duration would make some sense as long as the narrative isn't the Fed is cutting too late and they don't have inflation under control. And as we just talked about, it seems like we're a couple of steps away from that narrative coming into play.
Yep.
Yeah. And then on the equity side, some even brighter green here month to date. Small caps outperforming large caps. Again, recovering some of those April losses, but still sitting negative quarter to date for small caps. What's important to know in the equity space?
U.S. equities have recovered all of their April losses. They're back up to all-time highs. Small caps have recovered almost all of their April losses. So you can see the market really willing to buy the dip here, even if there's weakness in the economy, because of what we just highlighted there, that the Fed is more of your friend now, whereas before last year they were maybe your enemy. And then also going on in foreign equities, emerging market equities have done very well. China has started to come back. We don't think that has legs necessarily. Data came out over the weekend showing Chinese housing prices across pretty much all tiers and cities in China falling very sharply. And it's clear that all these piecemeal measures that the Chinese government has come out with to try to stop the decline in Chinese home prices, it's not working. And that definitely is worrisome. If you think about consumption in that economy, you think about how government is going to reach their economic growth target if the consumer is in a balance sheet type recession. People look at houses much differently in China than they do here.
Yeah.
Houses in China, they are the 401k. They are the retirement plan. They are the asset. And if those things are going down in value, the negative wealth effect is way bigger over there than it is over here. And that's something that, unfortunately, China needs to do more to stop if we're going to get confident that, hey, this cheapness that we've seen in Chinese and emerging market equities, that it's an attractive entry point.
Right.
Haven't seen it yet.
Yep. Makes sense. All right, let's take it to the framework. We can start with inflation. Still expecting a pretty good decline here in late 24, early 25. And look, March 25, we're right at target, at 2% target.
Absolutely. Steady progress through this year. And then once we get into early next year, those hot months of this past January, February, March start to fall out, and we're right back to target. So once again, the Fed doesn't need core PCE to be at 2%. They need to feel confident that the dynamics are in place for us to get to something like 2% over a reasonable period of time. And we think we're on track for that.
Yep. Liquidity standpoint, still expecting, a small recovery in the second half of the year. We've got the balance sheet, pausing the balance sheet runoff, and of course, expected cuts in the second half of this year supporting that projection. Anything to add from a liquidity standpoint?
If the Fed cuts quicker, then that line's going to go up.
Yep.
Right. Usually the Fed isn't cutting quicker in a good market environment or a good economy, but what ends up happening is they boost liquidity, and coming out on the other side of it, it's a good time to buy equities.
Right.
So.
Yep. Speaking of that economic environment, projections here, still in that range that we described as sustainable but acceptable, right? 1.5% for, looking at Q1 25 there.
Yeah, still confident that the data thus far means we're going to be slowing in terms of pace of economic growth. The events of May give us more confidence in that forecast. What's really interesting, though, is if you look at GDP Now trackers, which we go back to this soft data, hard data thing, they're only focused on the hard data, the high frequency hard data. They're still upwards of 3%. So it's still touch and go here, right? That's the thing about the bumpy landing.
Yeah.
You're just hanging on to every single data release. You're at the edge of your seat because it could mean so much. 1 week jobs report, or the next jobs report comes out and it's gangbusters.
Yeah.
And we're just off to the races again, right?
Yeah.
So
we just need to get that Atlanta Fed GDP Now URL to some of those sentiment survey respondents, kind of balance them, balance them out a little bit.
Right.
We'll wrap up with the recession signal. Heavy truck sales red here. Still looking for one of the other real economy signals to trigger to activate that component. We talked about labor market signals, initial and continuing jobless claims still pretty healthily below that 25% threshold for a 12-week moving average. And as you mentioned earlier, recession signal remains inactive, but certainly something we're staying on top of in this bumpy landing type environment.
Yeah.
So that'll do it for us in this edition of CAP STRAT this week. If you have any questions or comments, please feel free to reach out.